Bitcoin mining is usually discussed through short-term metrics, price, fees, and hash rate. But to really understand the industry, we need to take a step back and look at it from a long-term strategic perspective. In this analysis, we break down the competitive structure of Bitcoin mining using Porter's 5 Forces framework. We will now analyze the competitive structure of the Bitcoin mining industry. We will first look at an overview of the total industry and the different players within this industry, and I will explain how they interact with each other from a competitive perspective. Then I will introduce Porter's 5 Forces framework, which is a framework used to analyze the competitive structure of various industries. We will then apply that framework to Bitcoin mining and analyze it through all these 5 factors. Then I will come with a conclusion of the total competitiveness of the Bitcoin mining industry, and we will go through some key takeaways and strategic implications for players within this industry, how they can deal with this competition. This map shows the simplified industry structure of Bitcoin mining. Let's start on the top. You see we have electrical infrastructure, mining machines, electricity, powered land. These are the 4 main input factors in Bitcoin mining. Thus, we have 4 groups of suppliers of these input factors that supply these input factors to Bitcoin miners. Bitcoin miners buy these supplies and use them to produce hash rate. Bitcoin miners then sell that hash rate to mining pools, and the mining pools ultimately liquidate that hash rate on the Bitcoin network. So in this video, we analyze the strategic group of Bitcoin miners sitting here in the middle. Porter's 5 Forces, what is that? Porter's 5 Forces is a very well-known framework for analyzing competitive structure of different industries. It's one of the most used strategic frameworks, and basically, it views competition as a very broadly. Like many people view competition as company A competes against company B, like one Bitcoin miner against the other Bitcoin miner. But that is a too narrow view of competition. It doesn't encompass the entire competition within an industry. So instead, we want to think much more broadly, and we want to see competition and analyze it from the relationships a company has with their suppliers, their buyers of their products, and we also have threat of substitutes, threat of new entrants into the industry, and all these factors push on the competition, and the stronger they are combined, the more competitive is an industry. So we will now go through them for Bitcoin mining. First, threat of new entrants. This is probably the most powerful of all these factors and the most dangerous of them. So here you see a simple illustration of how super profits in an industry eventually will lead to profit compression. So this is a cycle that goes on and on and on. It goes on in all industries in the world, and in some industries, this cycle is much stronger and faster than in other industries. For example, in Bitcoin mining, as I will explain. So how does this work? Well, a period of super profitability will eventually lead to capital inflows. More people want to start doing that business activity that generates very high returns. And these capital inflows will lead to capacity expansion with some lag, depending on how quickly you can get this capital in. And that capacity expansion, which is competition, will eventually lead to profit compression for everyone in that industry. So the important thing to note here, according to Porter's 5 Forces, as well as basically all other economical frameworks, is that high margins are always temporary, particularly in low barrier to entry commodity industries. So the important thing to understand is that the lower the barrier to entry, the more capital inflows can come in, and the faster that capital inflows can come in. That means that if there is a period of super profits in a low barrier to entry industry, more competitors can quickly come in, and that will lead these super profits to disappear quite fast. I will give an example from the taxi industry. It's one of the most competitive industries in the world, especially with the entrance of Uber and other alike. So I read in the newspaper about Uber coming to a city, and taxi drivers were very angry because the rates were pushed so much down. So we'll go through this example now. So Uber comes into a city. First few Uber drivers temporarily print money. Very happy they can make more money driving Uber because there are more customers for Uber compared to normal taxis. And then the market enters the stage 2, maturity. More drivers enter the market. So it's not that difficult to start driving a taxi. You basically, or especially at Uber, you just need a car and then you can start. The super profits go down. So we see here capital flow in, capacity expansion, profit goes down. Taxi drivers are not so happy anymore. And then in stage 3, market is oversupplied, rates plummet, nobody makes money. So in this market here, conditions are actually worse than they were to begin with because there's so many new entrants into the market who are allured by these super profits that existed in this stage 1. So then nobody are really happy. And this is a textbook example of how low barriers to entry means that there is a high threat of new entrants. And that means that this threat of new entrants is very high. And yeah, let's look at how that applies to Bitcoin mining. Bitcoin mining, you see here the chart of the hash price, which is the miner revenue, versus the hash rate, which is the total competition in the network among miners. And here you can see that in beginning of 2021, hash price revenue was quite high. Then it dropped a bit because Bitcoin price fell. But then what happened then was that China suddenly banned Bitcoin mining. So about 40% of the hash rate went offline very quickly. And that led the revenues in mining to quickly grow because there was less competition in the market. So here we see a period of super profits in mining. And guess what happened? Hash rate competition started piling in. And yeah, hash rate grew like crazy. And interestingly, we see here that Bitcoin price started falling in November 2021, and that led mining revenues to decline as well. But even then, the hash rate kept growing because more people was piling in, and that was just because it has some lag in mining. You know, you can't deploy a hash rate like instantly. You have to deploy the facility, the machines, etc. It takes 6 to 12 months to do that at a minimum. So a lot of this hash rate that was invested in, like capital inflows, it only came online as capacity later. And we see it kept growing after that. So in Bitcoin mining, if there is a super profitable period, the hash rate and capacity expansion will continue for like 1 or 2 years after that at a minimum because of that lag. So this is really driving the cyclicality of Bitcoin mining. So then we can conclude that the threat of new entrants is very high in Bitcoin mining. History is showing us that, as we showed in this chart. And fundamentally, it's not so difficult to start a Bitcoin mining operation. You need to buy machines, to buy electricity, get powered land. You need all these input factors I went through earlier in the video. And of course, you need to operate the facility well, but that's another question. So ultimately, there is low barriers to enter in Bitcoin mining, and there is a commodity output that anyone can sell. That means that the threat of new entrants is very high in Bitcoin mining. And I would say that this is the most pressing factor of all of them for Bitcoin mining. And this is the main reason why Bitcoin mining is such a competitive industry is because the very high threat of new entrants. Buyer power. So buyers and sellers, according to Porter's 5 forces, have a constant push for value capture between each other. So buyers and sellers are actually competing against each other from that perspective. Here you see 2 pie charts on the left side. So you have total value created, that is the total pie. So that is the total value created in industry. And then sellers value capture is the green, buyers value capture is red. So if the buyer power is low, you see here that the buyer's value capture is not so high and the seller keeps most of that value. But on the other hand, on the right side, if the buyer power is very high, the buyer can take most of that pie for themselves. So they can extract that value. All else equal, the fewer buyers there are in an industry, relative to the amount of sellers, the more power the buyers have, and thereby they can extract more value, negotiate better payment terms, better prices, etc. We will now go through an example from the regulated power generation industry. So in some countries like Indonesia, like I use PLN, that is the grid, the electric utility of Indonesia. In some countries and markets, there is mandate for all electricity producers to sell electricity to only one buyer, which is the electric utility, at a set tariff that is determined by the government. And in such markets, we understand that the electricity producers have absolutely no negotiating power, first of all, because the tariff is set by the government, and second of all, because they only sell their power to one buyer, regulated buyer. So this buyer has a monopoly on buying electricity in that market. That gives them extremely high negotiating power, and the electricity producers, they just have to accept the price that the utility is willing to pay them. In Bitcoin mining, how is the buyer power? So as I showed you earlier in the video, Bitcoin miners produce and sell hash rate. That hash rate is sold to mining pools, who then resells it or liquidates it on the Bitcoin network. And ultimately, it's all ends up in the Bitcoin network. These mining pools, they have very weak negotiating power. It basically, hash rate just flows through them and goes to the Bitcoin network. So how big buyer power do you think the Bitcoin network have over the Bitcoin miners? Extremely high. There is only one buyer of that hash rate, which is the Bitcoin network. That gives miners very low negotiating power. They just have to accept the price they can get for that hash rate. And that price is even algorithmically determined. It's determined by the difficulty adjustment and the block subsidy schedule, and also transaction fees and the price of Bitcoin, which are market determined. But overall, the revenue of Bitcoin miners is completely algorithmically and market driven, and Bitcoin miners have absolutely no saying of how much they should sell their hash rate for. That means that the buyer power in Bitcoin mining is very high. Supplier power. This is similar to buyer power. We now look on the other side of the equation, Bitcoin miners, suppliers. How strong are Bitcoin miners relative to their suppliers? And all else equal, the more sellers there are in an industry, the more buyer power, the fewer sellers, higher supplier power. So we go through an example now from the airline industry, which is very similar to Bitcoin mining. So in the airline industry, you have only two primary suppliers of aircrafts. That's Airbus and Boeing. They sell to many buyers. There are thousands of airlines around the world. So, of course, that gives the aircraft manufacturers extremely high negotiating power. The airlines have to just accept the prices that the aircraft manufacturers set for their planes. And this is particularly interesting because airlines is a very cyclical industry, and economic upswings, the airlines do very well, people travel a lot, and then they want to buy more planes to expand their capacity. And what do you think happens then? Well, the aircraft manufacturers increase their price proportionally. So that means that the aircraft manufacturers can capture a significant amount of value in bull markets from the airline industry. This is very similar to how the dynamics are in Bitcoin mining machine manufacturers, where the manufacturers set prices based on the profitability of mining and thus can capture a lot of value in bull markets. I will go through that soon. So in Bitcoin mining, let's look on the total supplier structure. As I said, we have four primary supplier categories in Bitcoin mining: electrical infrastructure, Bitcoin mining machines, electricity, and powered land. Let's go through them one after another and analyze how much supplier power each of them hold. Electrical infrastructure. These are transformers, mining containers, etc. There are extremely many suppliers of these components, so that gives them very low negotiating power. Of course, right now we are in a bull market for electrical infrastructure because of the AI boom, but that does not change that there are extremely many of these suppliers, so they have low negotiating power structurally. Then mining machines. And here is where Bitcoin miners have a very weak negotiating power against them. Mining machine manufacturers have extremely high negotiating power. This market is an oligopoly with Bitmain, MicroBT, and Canaan producing like close to 100% of all the machines. And yeah, that gives them a huge amount of power, and they set prices for these machines depending on the market for Bitcoin mining. So they can set the price completely, and Bitcoin miners just have to accept this price. There's absolutely no negotiation involved from Bitcoin miners, at least very, very little. And then we have electricity. In electricity, there are also thousands of providers around the world. So that gives them low negotiating power relative to Bitcoin miners. Of course, that assumes that Bitcoin miners are mobile because you have to move if you want to buy electricity from a different provider in most markets. Then we have powered land. That's a similar story. Powered land is land close to a big source of electricity, like a substation, etc. And this land is, as you know, land is one of the most distributed assets in the world when it comes to ownerships. So there is extremely many different landowners in the world. So Bitcoin miners can go to so many of them and negotiate deals to be on that powered land. But of course, that also assumes that Bitcoin miners are mobile, that they're willing to move from one place to another. But overall, electricity and powered land have low negotiating power relative to Bitcoin miners. So, of course, as I mentioned, electrical infrastructure is in a bull market. I would also say that electricity and powered land is also entering a bull market right now due to the AI boom. But these market cycles do not change that structurally. They have a weak negotiating power relative to Bitcoin miners. But right now, of course, these assets are getting scarce and difficult to obtain, but still they have low negotiating power. They cannot really set the price. So given our analysis of all the 4 input factors in Bitcoin mining and their supplier power, I consider the total supplier power in Bitcoin mining as high. This is driven primarily by the machine manufacturers having extremely high supplier power. Bitmain, MicroBT, and Canaan, they can set the price of the machines how they want to. Hopefully for Bitcoin miners, supplier power will ease over the long term because there are a lot of new entrants trying to get into the machine manufacturing market like Block, Eurodyne, Bitdeer, etc. Things can improve for Bitcoin miners there. Threat of substitutes. So what is that? If an asset can be substituted by another asset or a good or service, then there is a high threat of substitute. And if there exists this threat of substitution, that creates a competitive pressure in the industry. Margins are reduced because you're not only competing against the players within the industry, you're competing against players a little bit outside of that industry as well. So for example, prime example here is streaming versus cable TV. So here you see in blue the number of cable TV subscribers in America by year, and in the red here, the number of Netflix subscribers by year. And you see here that number of cable subscribers went down, while the number of Netflix subscribers went significantly up. And this is, of course, because streaming is replacing cable TV. It's substituting cable TV, which is bad for the cable TV companies. It reduces their margins significantly. So how is that in Bitcoin mining? Is there really a substitute for Bitcoin mining, you might ask? There is no direct substitution for Bitcoin mining. Proof of work, which is the consensus algorithm of Bitcoin, is completely powered by hash rate. So it needs hash rate. And as long as Bitcoin is on proof of work, there is absolutely no direct substitute for hash rate. And I consider the risk that Bitcoin will move over to proof of stake as extremely low. That will, by almost all likelihood, never happen. So Bitcoin will stay at proof of work, meaning there is no direct substitution to Bitcoin mining. But we have an indirect substitution because Bitcoin mining revenues depend on the Bitcoin price as well as transaction fees. And these are market driven. And that means that Bitcoin price is heavily dependent on how much people believe in Bitcoin as a store of value. So in that case, Bitcoin competes against gold. Like gold is a substitution to Bitcoin. Some people buy gold instead of Bitcoin. And similarly, when it comes to the medium of exchange perspective or use case, Bitcoin competes against fiat currencies. So people use fiat currencies to transact instead of Bitcoin. That means that fees will not be so high. So these are substitutes for Bitcoin. Bitcoin competes with gold and fiat. So that means that there is some indirect substitution threat in Bitcoin mining. But overall, I consider the threat of substitutes in Bitcoin mining as low because there is absolutely no replacement for proof of work. So there is no direct substitution threat. But there is an indirect substitution threat from competition with other types of money or currencies like gold and fiat. But overall, at least I believe that Bitcoin will keep going up. It will keep taking market share from gold over the long term and be increasingly adopted as a medium of exchange, maybe not on the base chain, but on the like layer 2, layer 3, etc. So that means transaction fees also should go up. So because I'm personally bullish on Bitcoin, I consider the threat of substitutes, of indirect substitution, as not so high. But it is still there, so it's low here, threat of substitutes. My conclusion is that the total competitive rivalry in Bitcoin mining, based on all these factors we analyze in this video, is high. So threat of new entrants is very high. It's not that hard to get started Bitcoin mining. You just need capital. You need to get access to electricity, to machines, to electrical infrastructure, to powered land. But if you really want, you can do that, and especially if you have enough capital. So threat of new entrants is very high, and that creates a big cyclicality in the Bitcoin mining industry where periods of very high profits are often short-lived and followed by big bear markets. Then we have buyer power, which is also very high in Bitcoin mining. Bitcoin miners have to just accept the hash price. They have to accept the price they can get for their hash rate. No negotiating in that. Then we have supplier power, which is high. Bitcoin miners are extremely dependent on the machine manufacturers. Machines make up about 30-40% of the total cost in Bitcoin mining, maybe even a bit more. So that drives up that threat level significantly. Then we have threat of substitutes, which is low to medium. There is a few substitutes to Bitcoin mining. Key takeaways: Bitcoin mining is a highly competitive industry that is mostly due to low entry barriers, which leads to a flood of new entrants during bull phases. And on top of that, machine manufacturers have extremely high buyer power, which allows them to set prices according to the revenues of mining, and thereby they can capture a significant portion of that value created in the bull markets due to high supplier power. And all of this basically means that super profits are made in the bull cycles, particularly if you invest in machines before the bull cycle begins. Because, as I said, the machine manufacturers have a very high supplier power, so they will increase the prices of machines if the bull cycle has already started. So the only way to really make big bucks in Bitcoin mining, if you want to time the cycle, you should try to invest in bear markets and hope for a bull run to start. Bull cycles in Bitcoin mining last about 1 to 1.5 years, which is the time it takes for new hash rate to come online. Because as I explained, due to low barriers to entry, there will be a flood of new entrants coming in during these bull cycles. And that leads to often a big bear market in the end. And in the long term in Bitcoin mining, you can try to play the cycles and everything, but in the long term, the only viable strategy is cost leadership. You have to get your costs lower than most of the competitors. For more long-term strategic analysis on Bitcoin mining and energy infrastructure, you can find the research and insights at hashlabs.io. And feel free to follow Hashlabs on platforms for future briefings. Thank you for watching.